Hello and welcome back to this trader training video series. On this video we're going to continue to look at a stock replacement strategy, and all that really entails is replacing what you might have done previously with stock, with forex, with spread betting, with CFDs, and simply replacing that with options. So when you've decided on your trade, and for the purpose of this we'll assume that we're still bullish on the stock that we were looking at, and we will benefit if the stock rises. So when you move over to your trade tab for the options, you'll be presented with the option chain, and we've looked at these on previous videos. The thing that we need to note here is that each option expiration has an expiration. So we want to make sure that we have enough time for our trade. So what I'm doing is I'm just looking down the dates, and I'm just basically seeing, do I have at least 25 days and ideally about 45 days. And I also want to look at the monthly options. So what I can do is I can look down and I can see that this monthly option just by the cursor has 23 days, so there's not enough days. Skipping the ones that are slightly different color because they're weekly options, we'll cover that on a different video. And I can see that the next monthly option has about 51, well, it has exactly 51 days before it expires. So it's a little bit more than I'd like for preference, but that is just fine. Now, the point I'm trying to make here is that for your strategy, you need to make sure that you have enough time. On average, my trades last 7, 10, 15 days, so I want a little bit of wiggle room in case it doesn't initially go my way straight away. So I'm typically using the next month out, which is about 45 days, and that's to encompass what we've described on previous videos as the backup plan. I've got time to be right if I'm initially wrong. So if you've got more of an investment strategy, you can basically go out to, at the moment, 2 years in advance. So if you wanted to use options as a stock replacement for investments, then that can be done as well. Anyway, for me, it's going to be 51 days, and I'm just going to expand those details there. So when we expand the details, you can see that there's essentially a table, and again we've looked at this on previous videos. Down the center we have the strikes, on the left we have calls, on the right we have puts, and if I'm bullish and I'm going to be buying options and replacing what I've done previously with the purchase of an option, then I'll be bullish by buying calls and I'll be bearish still by buying puts. In both cases, you would be a buyer. We'll look at obviously other strategies in later videos, but essentially this is what we're doing. So we'll be bullish if we're buying calls and bearish if we're buying puts. Again, in both cases, you would still be a buyer. Now we've already decided that I'm going to be bullish for the purpose of this example. So what I'm doing is I'm going to focus my attention on the left hand side, which is the calls, because that would express the bullish viewpoints that we've just been talking about. And also on a separate video, we've looked at the difference between in the money and out the money. So I won't labour the points here, but you can see that there's a slightly different shaded division on either side of the table, and essentially it's in the money and out the money. Now, the strategy for replacing stock or spread bet or forex or CFDs, what you've done previously, is very simple. All I'm going to do is buy the first strike out the money, OTM. Again, we've talked about this previously. So the first strike out the money, again, we can see the stock price at the top left here is $118. We can also see the slightly separate color division. So anything above $118 is out the money. So that's this strike here. So the nearest strike, that is the first strike out the money, is going to be the $115 strike, and that would be the one that I purchase. And very simply, all I can do is just click on that and it will populate an order down at the bottom for me. Pretty neat, and that's it. So, bullish replacement strategy is to buy one strike out the money on the call side, and obviously if you're bearish, you're still a buyer and would be to buy one strike out the money on the put side if you're bearish, meaning that your benefit of the stock goes down. So I'm going to click on the ask. You can also right click. Let's just go through that. You can also go through the right click. This has got a pretty neat feature. You can go to right click, buy, and it would just be a single option. That's your other choice that you have available to you. Down at the bottom, you'll get your order tickets. The only thing that you need to check is your position size, and we need to check the price. Now, the thing that we're checking on the price here is that, again, if you look a little bit further down, we want to make sure that we're buying on the mid price and not the natural price. The natural price is the market price, and this is the last thing that we get to control, is how much we pay. Now, the way that I usually describe this is it's like when you go to a car dealership and the market price is the price that's on the windshield. You've got the big price, that's what's advertised. And it might be that the car is, let's just say 10,000. So it's got 10,000 on the windshield, but you know that you can go to the dealership and say, what's your best offer? And quite commonly, you'll be able to negotiate a discount. And that's what we're doing. That's the difference between the market price and the mid price. We're basically saying to the market, what's your best offer? And the best possible offer is the mid price. So that's what we're going to negotiate with the market. So the last thing that we get to control is to make sure that we get the mid price. Now, there's not that much difference in it on this stock, but there can be 3 cents, 5 cents, 10 cents, 20 cents, and in some cases 50 cents difference between the mid price and the market price. So while it doesn't look that much on this example, keep an eye on it, because on different occasion with a different stock, there could be a very vast difference. And if you're paying an extra 10 cents on the purchase of your option, per contract, that's $10. That is going to be a cost that adds up to a significant amount over time. So we always want the best possible price. So the best possible price is the mid price. And that's it, folks. That is our stock replacement strategy. Very simply, to take what you've done previously and to decide on your direction. So if you're bullish, you would do this on the call side. If you're bearish, you would do it on the put side. And all we're doing is buying one strike, the first strike, out the money. And the last thing that we're doing is we're just checking that we've got the best price by making sure that we're buying on the mid price. And that's it, folks. That is our stock replacement strategy.